Hello and welcome to IndianMoney.com's YouTube channel. My name is Fayaz. There are only two ways to create wealth for yourself, either by investing in equity or creating asset for yourself. Well, equity is in a way asset in itself, but if at all you are actually thinking of investing in any kind of shares or probably start your investment journey, then you have definitely come to the right place, because in this video we'll discuss about the 5 simple techniques or the 5 simple ideas which you basically have to implement to ensure that you're trying to minimize your losses and eventually you will be able to maximize your gains, because in stock market in today's day and age, almost 95% people end up losing their money and only 5% are the ones who are able to create magnanimous wealth for themselves. So in this video, we'll try and understand this particular concept in detail. So without further ado, let's get straight to the point and start with the video. The number one thing that you have to do is that you need to keep your emotions at door if at all you are entering in the stock market. A lot of times in life, whenever we are about to take any particular decision, we always look for a sign, we always look for our gut feeling, we always look for a sign from the universe, and then we end up taking those decisions. But when it comes to stock market, when it comes to investing in shares, Warren Buffett has quoted it several times that you should never listen to your gut feeling. You should probably listen to the company's fundamentals, probably understand the company's P ratio, probably see whether the company is undervalued or overvalued, and then you should probably be taking a decision whether you should invest in that particular company or not. And often we end up ignoring all these important criteria and we just go with the flow and we end up losing our money. So let's not do that. Try and understand the basics, try and understand the fundamentals of the company, and then you should probably move ahead and make that particular investment. The next thing that you have to do is that you need to pick companies and don't look for ticker to make the decisions. Often whenever we are looking at any particular business channel, then you must have observed that at the bottom of the screen there is something called a ticker which actually shows the share prices and the shares fluctuations. And often when we see that any particular company's prices are going up, we end up buying that particular company. We think that, you know what, this company is doing good. Yesterday it was like 200 rupees less, today it's 200 rupees more. Let me go and just buy that particular company. And the other day when we see that there is a crash in the price, we end up, feeling regretted about it because we did not actually thought through the entire process and we ended up losing our money. So that's not what the idea is about investment. Investment is basically a long-term thing, and a lot of investors in fact have told this particular fact that you need to actually invest and then just be invested for the rest of your life, and that's how you will be able to create wealth for yourself. There's actually a real story of a person who bought around 20,000 rupees worth of MRF share in the year 1990, and today those share prices are almost around 106 crore rupees. So you can imagine the power of compounding, the power of holding on your investment for a very long time, and you can definitely create magnanimous wealth for yourself and for your family, provided you are a value-based long-term investor. The next thing that you have to keep in mind is that you need to always plan ahead and think what will be relevant in future. When it comes to investing in companies today, often people just look at the current valuation and they just look at the price gains or the top gainers of the stock market and they end up buying those particular companies. But if at all you want to actually become a long-term value-based investor, you need to always think ahead of time and you need to always invest in the companies which will probably be relevant in the years to come. For example, in the year, say 1990s, when Infosys and Wipro and every other technological based companies came in, not a lot of people believed in such companies. Not a lot of people were confident about investing in such companies, and those who invested then are able to basically see that they have definitely created a huge amount of magnanimous and huge corpus for themselves. So if at all you actually want to create a similar amount of wealth for yourself, then definitely you should be investing in the companies which will be relevant in the years to come. What would be something that will be relevant in future? Probably electronic cars, probably more about things which are dealing with fitness or health, or probably things which probably will be OTT based. For example, people are not pretty much going outside to buy things now, and they are preferring to order things via the online delivery applications, or probably they are watching a lot of movies and web series based on the OTT platforms. So you can imagine that what will be relevant in the years to come, and then definitely you can choose such kind of companies, such kind of business models, and you can definitely invest your money in such companies, and eventually you'll be able to see that you have made the right decisions, provided you have done your research and provided you have understood the company's fundamentals, and only then you should be actually going ahead and making that particular investment. The fourth thing that you can do is that you need to build your position gradually. Often when people get excited after listening to the success stories of stock market, they end up putting up a huge amount of money in any company that they like, and whenever there is a crash or the fall in the prices, they end up losing that particular money, and not just losing the money, they also lose, or they felt like a loser in their heart as well, because they feel that, you know what, I shouldn't have invested that particular money. But if at all you do not want to take such chances, and if at all you still want to invest in stock market, there is an easier way to do it, and you can probably apply the SIP approach here, which is basically, if at all you liked any company, say ABC company, if at all you want to buy this particular company's shares, so instead of putting say 50,000 rupees or 1 lakh rupees at once, try and implement the idea of applying the SIP approach by putting up say 5,000 rupees or 3,000 rupees or maybe 1,000 rupees every single month, and slowly you'll be able to create some amount of good chunk of that particular share in your demat account, which will not only help you to save a lot of your money, you'll be able to get the advantage of the price fluctuations, and also it will be pocket friendly for you. It will not be a burden on your pocket, it will not be creating a hole in your pocket. So eventually this particular approach is something that you can utilize if at all you are a beginner, and you will be able to see that you have taken the advantage of the averages and you have taken the advantages of the price fluctuations as well. The fifth thing that I would like to tell you is that do not really have a herd mentality, especially when you're going out to make your investments for the very first time. Often we get influenced by our bosses, by our colleagues, by our friends, or probably by our favorite article, or probably by our favorite influencer on maybe Instagram or YouTube, and we end up buying those particular companies' shares. But actually you need to have a basic understanding of what that particular company is doing, and will it be relevant in the years to come, whether their debt to equity ratio is fine, whether they are a debt free company, whether they're having a monopoly, or whether they're having the right kind of positioning in the market, and if at all that company is overvalued or undervalued. And then you can probably, after figuring out all these aspects, all these particular angles, then you can probably go forward and make that particular investment, rather than just going with the flow of what your friends are doing or probably what your colleagues are doing. Often we end up losing money, and that's what happened during the IPO rush. In the year 2021, we witnessed that in the first quarter, there were so many companies who were issuing their IPOs every single day, every single week. Almost we came across at least 2 or 3 IPOs, but most of them actually ended up losing a lot of money, especially the companies that came in the last few days of March 2021. So here's an important lesson for all of us. Don't really go for the listing gains. Don't really go for the short-term gains. You should rather be a person who's basically investing for a longer tenure, and only then you'll be able to create wealth for yourself, just like what Rakesh Jhunjhunwala has done for himself, or probably what Warren Buffett has achieved for himself. And if at all you also want to become the Sultan of stock market, then you should definitely download the Financial Freedom app. There we have made more than 75 plus courses, and every single week you'll be able to witness that there is a new course that's coming up in every 6 of the languages that we have basically mentioned in this particular application, which are available in this particular application, which is Hindi, English, Tamil, Telugu, Malayalam and Kannada. And when you download the application, don't forget to give my name in the promo code and get a scholarship of rupees 2,000 absolutely free. Until next time, my name is Fayaz and you're watching IndianMoney.com.